supposed to be here.
All right, let's make a start. Thank you very much for joining us, ladies and gentlemen. It's a busy day, a busy afternoon, and lots of choice in these events, I'm aware. We're a parallel session. But I'd like to say, I think we are the most important parallel session. I'm sure everybody else is saying that as well, but none of the rest of it happens without the money. And here is where we're going to be discussing the money. My name's Robin Amlow. I'm the managing editor of CPI Financial here in Dubai. We publish a couple of magazines all about money, Banker Middle East and Banker Africa. And that's pretty much why I am your moderator for this session. Joining me up on stage is Dr. Mohammed Omran, chairman of the Egyptian Exchange, Amir Sheikh, Chief Legal Counsel for African Legal Support Facility. He's based in Tunisia, and he's asked me to point out that the African Legal Support Facility is part of the Africa Development Bank Group. Next to him is Stella Kilonzo, who is the founder of Astute Capital Kenya and has been involved in the capital markets development team there. Hitaj, and I can't read my handwriting, Asapoda of Emirates MBD Capital is next. And, oh no, he's right at the far end, I'm sorry. Before him we have David Ofunji, who is the Regional Director of Blue Financial Services and the founder of Dero Capital. Ladies and gentlemen, this is your panel. The format of this, insofar as I would like to be able to do it, is going to be informal. Nobody is going to be making a presentation. We are going to have a conversation and possibly an argument in one or two places up on stage. And we'll do that for about 35 or 40 minutes, and then please feel free to join in, because we want your feedback, and I'm sure you'll have questions of some of our panelists here. So just to set the scene, things have changed an awful lot, have they not, in the last decade as far as Africa is concerned. I've got some very basic numbers here which I'm going to quote to you. They're from Thomson Reuters. In sub-Saharan Africa in 2012, there was $4.8 billion worth of equity capital market issuance. In debt capital market issuance, $11.8 billion. And $25 billion worth of activity in mergers and acquisitions. We have capital markets that are active, we have capital markets that are growing and evolving. But what's actually been behind the change? Where's this coming from? And I'd like to start with that. Hitaj, as the investment banker on stage, perhaps you could set the scene for us.
Thank you, Robin. Well, to all those who are visiting from outside Dubai, on behalf of Emirates NBD, wishing you a very warm welcome to the city. In terms of capital markets, what we've seen is a very fundamental shift in the way financing happens. If you just step back a few years to 2006, about 50% of the financing in the US market happened via capital markets, but only 25 to 30% of the financing in Europe happened via capital markets, and only 5% of the financing in the Middle East happened via capital markets. Fast forward 3 years to 2009, and we saw corporate bonds in Europe exceed corporate loans in Europe for the first time ever. And the margin by which they exceeded corporate loans was very high, fundamentally driven by banks deleveraging, Basel III capital requirements, placing more stringent rules on capital and longer-term financing, very strong demand from investors outside the banking market, and so on. So in summary, we've seen a very strong shift where capital markets now are a very essential part of financing for not only developed markets, but also increasingly emerging markets like the Middle East. And going forward, we expect that to only gather more force in terms of, in the context of Africa, I'd like to summarize with is that's a very important tool to access capital, which is one of the few key hurdles that Africa has in terms of growth, and putting the right regulations and putting the right infrastructure in place to access that capital will be very essential for the next phase of growth.
In terms of Africa's capital markets, of course, we have seen some startling, and I do use that word correctly, I think, startling successes. There's another gentleman on stage who has those numbers, who insisted on bringing his iPad with him. Emir, perhaps you'd like to cite those figures that you were so worried you wouldn't remember.
Sorry, I apologize. I have outsourced my brain to my iPad, so all my memory is sitting here next to me. One of the things that we've been seeing more and more of, and seems to be garnering interest, is the sovereign debt markets. Sorry. There we go. Is the sovereign debt markets. So in particular, just last week, Rwanda placed a $400 million Euro bond that was oversubscribed to the tune of $3 billion. And then after that, or just prior to that in 2012, Zambia had issued a 500 million Euro bond, and it was oversubscribed by a factor of 16. So they ended up reissuing and selling $750 million worth of debt. These are some of the examples of sovereigns beginning to tap the markets, the international capital debt markets, which are a prerequisite before commercial entities can enter the international capital debt markets. So without the sovereign bond rating as the basis, that basic, okay, the government can pay, that really opens up the commercial paper markets.
Well, what's actually changed? So nobody's explained to me yet what's actually changed that makes this feasible, particularly in sub-Saharan Africa. Stella, David, perhaps you'd like to enlighten us on that.
Yes, what has actually changed in the African landscape is really demand for infrastructure that has, and the policy decision for African governments especially to invest in infrastructure. That has created demand for debt. And how Africa, especially Kenya, has practiced it is by issuing infrastructure bonds. As I said, and just taking on from what was said earlier, liquidity did dry up in Europe, and there was need to obviously look at greater ways of financing. And that greater way of financing is by obviously using the local denominated currency bonds, which again were geared towards infrastructure. And fiscal incentives were also provided for the Kenyan investors and also the foreign investors. So they were all treated the same. They were not, there was no distinction whether you were a Kenyan investor or whether you were a foreign investor. And so you found that you could actually earn even an 18% return because any infrastructure bond that was issued with a duration of over 3 years actually had a tax waiver, and there was no capital gains tax on the same. So what has actually changed is obviously looking at Africa, looking at where the returns are, because in Europe and probably some of the other developed markets, the economy was not doing that great, but you can actually have the returns in Africa. Then the demand for infrastructure is big. The demand for us to have infrastructure to finance the mining, the oil and gas, housing, you name it, is right there, the roads as well. So that has been a key issue as well.
If I may just add, Robin, I think the key theme we picked up in the plenary sessions today was the bridge that we need to, the divide between the perception and the reality, which may be a surprise to many here, but that's progress, because prior to that it was bridging perception and a very distorted reality about African capital markets. I come from the other side of the fence where the business I represent, Blue Financial Services, is doing good things in microfinance in Africa. We are hearing a lot about the potential, but it's just key for Africa to convert that into the kinetic. And one of the things that we're facing still in capital raising is the situation around the perception of credit risk. We still have to go through DFI intermediaries to get balance sheets. We still understand that there's a place for that, but last time I heard, I don't think Mark Zuckerberg went for USA to bridge his risk profile when they were listing Facebook. I think with returns that was spoken about earlier today, 57% in Zambia and high or low 30s in Kenya and Uganda, I think the capital has to really be mature about appraising risk, and from that perspective, the money has to follow suit. And I think that conversion is where we're really going to take off from the current status quo.
I was also going to say, I think one of the big changes has been the growth of the middle class. It's led to a shift in the economy away from its overdependence on the super cycle of commodities and a switch to actual consumption. You've now got over, I believe they estimate about 350 million Africans are in the middle class, making above the poverty line now. So there's been a fundamental shift, especially in the last few years. There's been a real push upwards in the pyramid, I guess.
And I may also add, locally grown companies are also a big stakeholder. We have seen local consortiums who are basically investing, so they're not necessarily small, medium enterprises. They may have started out as that, but they're now growing. And we have local private equity companies. For example, in Kenya, we have Trans-Century, and it's invested in a whole conglomerate. I'm sure there are examples in all of Africa. And these are also making, they're also issuing debt. So corporate debt is something that they're issuing, be it infrastructure bonds for housing. And so you're finding that over reliance. Again, they know the risk. They have done business in Africa. So they are able to actually say, I'll be able to issue this, or I'll be able to undertake this transaction without necessarily relying on that US aid or some of the other development partners.
Well, it seems very basic. It is very basic to say this, but for capital markets to work, for any capital market anywhere to work, its raison d'etre, its reason for being, is for governments and corporates to raise money. But for people to be prepared to buy into that, there has to be a ready secondary market as well. People have to be able to get their money out, and to be able to get, and these instruments have to be tradable, which means you have to have institutions and indeed individual retail investors prepared to trade these things. The growth of the middle class in Africa creates a constituency that would be prepared to do that, whether they do it as individual investors or whether there's a pension fund doing it for them. But if we can come specifically to a market now, that the representative of a capital market sitting here, of the Egyptian exchange, what are the lessons that what is, I believe, the second largest exchange on the continent has for the rest of Africa?
Yeah, actually, before we start talk about the market itself and your previous question of what is changing, the changing is a natural of what's happening in the world economy. 40, 56 years ago, we're talking about the sophisticated markets, and then we were talking about emerging markets in Latin America, and then we're talking about emerging markets in Asia Pacific. Now, times come to Africa. So I guess the next destination for investment and for the continuing activities in the world economy will shift to Africa. In the last 20 years, we were talking about the emerging market in Latin America, Asia Pacific. Now, the next destination is Africa. But what is important here is that most of the countries in Africa and in the Middle East, they are bank-based economy. When we're talking about the financial structure of any economy, we're talking about bank-based economy versus market-based economy. But recently, in the last 5 to 10 years, there is a little bit of shift from banking to be dominating activities in the access to finance. Slightly, we are moving to the capital market. And our experience in Egypt is that in the last 10 years, instead of the banking sector in Egypt was dominating around 90% of access to finance or providing lending to corporate and individuals, now we are talking about the range of 75 to 80%, and 20 to 25% are moving to the capital market. Thanks, of course, for the good economic policies, including financial liberalization, including privatization policies, as well as to set in place the right regulatory framework. So the most important thing before you are starting to enhancing your market is to understanding that you have the right tools in the market, not only in terms of the regulatory framework, but more important is to enforce this regulatory framework. I still remembering one of the best paper I was reading when I was working in the academia. I think it's a paper published in Journal of Political Economy about the law and finance. I think that was the Schleifer, Laporta, and other people, and they were talking is that rule of law is very important. What is more important is how to enforce this law and make it work.